I want to give other people maybe a minute or two more, before we go ahead and start the program. If you guys could let me know that you hear me okay and that you see our value charts. I want to make sure everything's functioning properly. Could someone please give me a yes in the questions box? Thank you very much, Brad. I appreciate that. Okay, I'm going to go mute here for another 45 seconds or so, and then I'll come right back, and we'll go ahead and get started this evening. Okay, everybody. Thank you very much for joining us this evening. It is Tuesday, September 3rd, official start the fall business and trading session. This is when everybody comes back from Nantucket and their shore houses. They come back in New York City and they go ahead and get started. So we ease back into it this week and start trading. So there's a lot of great opportunities out there. We've had a lot of good successes over this summer in the Options Live Trading Room, so we're really looking forward to continuing all our great progress out in there. Tonight, first of all, I just want to introduce myself. A lot of you are familiar to me, so a lot of you, the names, I forget, maybe some of you are still new to our webinar series. If so, welcome. Again, my name is Dave Aquino, and I'm the Options Live Trading Room Specialist here at MicroQuant. And tonight, I'm more than happy to bring you the newest Value Charts webinar series program. And the name of tonight's program is Equity Portfolio Protection with Options. With some of the volatility just in the past week and a half with Syria and things like that, people start to think about protecting their holdings. What are they using to hedge their longer-term positions? So we're kind of approaching things tonight from the aspect of, well, maybe you have a trading account. That's what you use intraday and positions. What do you do with the 500 index fund that you have in your IRA? How can you kind of hedge that from some of these ups and downs? And I'm going to give you some ideas. And then, as we're going on, if you guys have questions or, anything that you'd like to say, go ahead and put them in the questions box for me. Okay, so again, equity portfolio protection with options. Okay. Now, just like I was saying, if you think of any questions during the presentation, please go ahead and submit them via the GoToWebinar side menu, where you put the yeses earlier for me. That would be great. I'll try to go ahead and answer all the submitted questions at the same time if it's presenting that material, if it's specific to that particular focused topic. If not, I may delay them to the end of the session, and then that way to any questions that they may have. So before we go, I'll always make sure that any questions are addressed. All right, so first of all, this is our risk disclaimer. We at MicroQuant want you to know that trading or investing carries a high level of risk and is not suitable for all persons. Before deciding to trade or invest, you should carefully consider your investment objectives, level of experience, and ability to tolerate risk. This content is subject to change at any time without notice and is provided for the sole purpose of education and assistance in making independent investment decisions. ValueCharts.com has taken reasonable measures to ensure the accuracy of the information contained herein. However, ValueCharts.com does not guarantee its accuracy and is not liable for any loss or damage which may result directly or indirect information or any delay in or failure of the transmission or the receipt of any instruction or notification in connection herewith. Any past performance results are shown for illustration and example only, are hypothetical, and as such have many inherent limitations. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown. And most important here, past performance is not necessarily indicative of future results. Okay. Next is CFTC Rule 4.41. Now this is a U.S. government required disclaimer. The CFTC wants you to know that futures and options trading not only has large potential rewards, but also large. You must be aware of the risks and be willing to accept them in order to invest in the futures and options market. This is neither a solicitation nor an offer to buy or sell futures, stocks, or options on the same. No representation is being made that any account will or is likely to achieve profits or losses similar to those discussed on this website. Again, the past performance of any trading system or methodology is not necessarily indicative of future. Okay, so if you have any questions at all on either of these two disclaimers, feel free to go ahead and contact us at MicroQuant. We're happy to answer any questions that you may have. Okay, all right, well, first of all, before I get started, I just wanted to say good evening to everybody. You guys, I've seen a lot of people come to my webinars, come to my room, and everybody saying good evening, so I appreciate that. All right, so now moving on to the tonight's webinar, equity portfolio protection with options. Okay, now before I really step into that, it's not very complicated type of strategies. It's more of a way of thinking about longer-term positions. But the first thing we need to do is just kind of summarize here. Again, the indicators we're going to use tonight, value charts and value bars. A lot of you are familiar with those. We're going to use MQ Regression MQ Trend. Also going to also use exponential moving averages, EMA. The techniques that we're going to use are trend following and also range trades. Okay, I would say a little bit more so the range trades than the trend following, but we have had instances where both come into play. The reason why it's a little bit, those of you that have been in the options room know that we do intraday trading, we do swing trades that might last anywhere from 1 to 3 days. We have to change our thinking just a little bit because the type of trading we're going to be talking about are longer term type trades, okay? And then how we can best position ourselves to protect our longer term portfolio. So really tend to follow more so range trade type trades, and we'll go into that. But I wanted to let you know these are the indicators we're going to be using, and these are the type of trades we're going to be following tonight. Okay. Now, for those of you that are a little bit new to value charts and MicroQuant, let me just take a moment to help you understand the way we see technical analysis. Basically, before we can talk about more of the indicators and the actual trade setups, you need to understand how we view the three most important components of technical analysis: price, value, and momentum. Now, by combining all three aspects of technical analysis, we believe that will provide traders with the most complete view of the current makeup of a market. Okay? Now, just to get into there specifically, what do we mean by price? Well, that is the current numerical value of a stock or a commodity represented easily by traditional price charts. You've seen them before, open, high, low, closed bar charts. Now, for the value component of technical analysis, that is the value charts and value bars indicators. For momentum, we use MQ momentum and momentum positions. And then trend following. We have our MQ regression and MQ trend indicators. They're part of our overall MQ momentum suite, and they help us identify trends and also gives us a good feel for maybe a range of how stock prices are moving in one direction or the other. So we will continue with that. Now, again, the settings for the indicators that we'll use, value charts and value bars, uses a 5-bar analysis period. MQ regression, we use a longer 100-bar analysis period. MQ trend is 21.4, and MQ momentum is the 32.55 setting. This is the default setting for MQ momentum. Okay? All right, now, what do we mean by value? Excuse me, pardon me 1 second. Okay, so I had to take a sip of water there. All right, for value. Normally when we open the Investor's Business Daily or Wall Street Journal, we see value. What the financial news refers to as value is a subjective opinion by analysts or a group of analysts or a group of fund managers that say a stock or a company is currently priced under value, or when they say it's a value mutual fund, basically it means they believe that the companies that they're buying at the time is undervalued, that they're buying it at a discount. Okay, but the essence of their analysis is that their analysis is based on opinion of an individual or a group of individuals. What we mean by value is we mean an objective evaluation of the current price based on the real historical past prices within an analysis period. Okay, so it's almost like we're not making this up. The valuation is based on previous prices within the analysis period. Now, for value charts, this is what you normally see. We have 5 primary valuation zones. Okay, the first zone is this center green zone representing fair value. Then we have this yellow zone above and below fair value, and this is the moderately overvalued level, and this is the moderately undervalued level. And above and below that, we have these red extreme value zones, and this is significantly overvalued and significantly undervalued levels. Now, those are important to know because historically, prices are contained within fair value roughly 66% of the time. Now, when we see prices in the yellow zones, moderately overvalued, we see prices in that zone roughly 16% of the time, and moderately undervalued roughly 16% of the time. Now, if you do the math, you'll know that the red extreme value zones, prices are in those zones roughly 1 to 2.5% of the time combined. Okay, now that is important when we're evaluating where prices are, because you can see that the majority of the time prices will be in the green valuation zone, and then just every once in a while in the yellow valuation zone, and then very rarely in the extreme value zone. Okay. All right, next is the traditional open, high, low, closed bars. Just to review in case you're not familiar with the definition, but basically the open, high, low, closed bars have been used over 100 years. They're a very good representation of price. This is usually price here, this axis, okay, over time. Okay, now each bar, amount of time, if this is a 5-minute bar, all the transactions within 5 minutes, or if it's a tick chart for a specific number of price change transactions. If it's a 100 tick bar or 250 tick bar, that's how it's represented. Now, normally you got the opening price on the left side, you have the closing price on the right side, you have a high price, and then you have a low price, and then you connect it with the line. That's the body of the bar. Okay, that is the traditional open, high, low, close bars. Next, you want to see that, okay, I see this all the time, it's all in my charts. How do we bring value charts into it? So basically what you can see is as prices are moving up and down, they're also moving up and down within the 5 valuation zones. When prices move up, majority of the time, let me just backtrack here, majority of the time, prices correspond to an area of value in the green fair value zone. You can see that all through here. Okay. Now as prices come down, they might hit the moderately undervalued zone, just like this. And if they come down either rapidly or significantly, you'll hit the red significantly undervalued zone. And then vice versa. As prices move up, prices can hit the here significantly overvalued levels. Right here at the top. Or better example, right here, this move. Okay, but what you can see is that with value charts, we get a very good picture as we're comparing it and utilizing it with our open, high, low, close bar charts, that where this current price falls within. However, when you're in a fast-moving market, it is a little bit, you have to see what the value is here and then see what the price is here and then come back to the value here. It's a little difficult to do. So what we've done is combine value charts with the open, high, low, close bar structure and created value bars. And this is the standard display that I use in my trading. And now what you do in one chart, you can see not only the traditional open, high, low, close bar structure, so you know where it opened and where it closed and how high and how low it got, but you can also see as prices are in this area, it's significantly overvalued, and then anything below this particular point, prices in here are moderately overvalued. So with this type of display, that allows us to identify both pieces of information very quickly. Very good for short-term and quick trading. Okay. Also keeps the charting very neat, so it's actually very convenient to have both price and value on the same chart. Okay, now this chart, this right here, demonstrates our MQ regression and our MQ trend indicators. Again, basically, it's very straightforward. When MQ regression is this red line running through the chart pattern here, and then it goes to green, red, and back up to green. Okay, it's very simple. When the chart pattern is bearish or negative, MQ regression is red. When the chart pattern is price action is positive or bullish, the MQ regression line is green. Now, it does not actually serve for a particular an exponential moving average. What's important with MQ regression is the color and every once in a while the slope of MQ regression. That's a little bit beyond the scope of what we're doing here tonight, but just to know that when MQ regression is red, prices tend to fall, and vice versa. If it's green, prices tend to rise. MQ trend is basically the same thing. See, MQ trend is green in this area, so it is bullish for the current price action. When prices fall below the MQ trend level, the dots turn red, so that becomes a bearish indicator. Now, usually we use MQ regression and MQ trend in conjunction with each other, so that we wait for both of them. Regression is red, MQ trend is red, so it's okay to be bearish and take a bearish position. Here, as it goes from red to green, now we have MQ regression green, but MQ trend is still red, so we don't get to become bullish on this until MQ prices push above the MQ trend dots, and once it does that, MQ trend becomes green, then it becomes okay to be bullish. Okay, that's how we use MQ regression, MQ trend to help us determine direction of the current trend. Okay. Last but not least, MQ momentum. It's one of my favorite indicators other than ValueBars. And basically what MQ momentum does, it measures the momentum of price movements. It seeks to gauge the momentum of a market. Is it becoming more bearish or is it becoming more bullish? Okay. Basically, it's very similar to a MACD, moving average convergence divergence indicator, something that Mark Helwig developed. It's basically a hybrid of what you'd normally know as an MACD, but a lot of important momentum factors have been combined. And basically what you're doing is you have two lines. You have the solid line, that is the indicator line, and then you have this dotted line here. That is the slow line, and then you have the histogram bars, which basically show you the separation between the indicator line and the slow line. When the most important factor to understand is when the momentum is when the histogram is red and negative like this, then the momentum of the price action is bearish and it's going down. When momentum changes and it becomes bullish, you see the fast line is above the slow line. The histogram is green and positive. The price action then becomes positive and tends to be bullish. Okay? So that right there, you can see that MQ momentum provides a really clear real-time view of both the direction and the strength of the market. You can see the bullishness is quite strong, histogram bars are quite tall, and vice versa. When the histogram bars are much shorter, then this bullish momentum is much weaker compared to here. Okay? All right. Now, do we have any questions so far regarding any of the indicators or basically how to utilize them? I know a lot of you are familiar with our indicators setups and systems, so I'm just looking. So I don't think there's any questions on any of the particular indicators. If there is, feel free to type it in. I'll be happy to step back and take a look at it. But kind of getting into the main part of tonight's webinar, and it's regarding portfolio protection and the kind of trading rules around it. Now, if we think about it, if we have a long-term, the long term is because we believe in the economic system of the United States or capitalism. So we believe that our investments over the long term will increase in value. That's just basically that's the faith we have in the free market system, that the businesses in general will continue to prosper and grow, and because of our investment, we'll be able to take part in that growth. Okay, so by definition, a portfolio is long-term bullish. Okay, but what we are trying to do is utilize options to help us protect the downside and maybe even bring in some additional income. Because you can think of it two different ways. I can protect my downside by earning more money, my downside by buying protection that will protect me in case the market does fall. So we're trying to utilize two different things. It depends on, I'm going to present you with a couple of ideas. How you actually pursue it is kind of up to you, okay? But just kind of things for thought. Some ideas on how to utilize options for the idea of protecting a longer-term portfolio, okay? Now, I know a lot of you have been in my room already. A lot of you are familiar with options, and I'm not going to go into the nitty-gritty of exactly which options to buy, etc. because this is kind of more an overall understanding of trading techniques tonight. Okay, so basically, let me see if I'm going to show you. These are the trading rules, but I want to jump over to the chart first. Okay, this is the S&P weekly chart. Okay, and as you can see here, since basically the beginning of the year, after we broke above this high right here, we've been basically in an uptrend. Okay, so we've been benefiting. Say we have a Vanguard 500 index fund, or whatever your favorite fund company, their index fund. So we can see that prices in the S&P have gradually increased during this entire period of time. Now, it does not follow a direct straight line straight up. We do have periods where we get high and then we pull back. We come up, make nearly the same high, pull back. Then we jump back up, and we grind higher and pull back, and grind higher, and then, you know, sideways, pop up, pull back. You know, you can kind of get a feel for it. So what you're trying to do is you can do one of two things. You just hold on to your index fund, and you know, eventually, if you have a nice bullish type market over the last 8 months, this is what you get, and you get an increase in your index. Now, if you want to be a little bit more active and you have value charts, well, this is the value bars, and this is MQ momentum on a weekly basis. We see prices come up here, hit significantly undervalued. Now, with that, you know that prices are only in that area maybe roughly 1 to 2.5% of the time. So you have a good chance of these prices pulling back. Okay, so what do? Well, you don't really want to sell your long-term position here. You want to take advantage, and maybe if it falls back, you earn some money. Okay, that's one thing you can do. You're not going to touch the long-term portfolio, but you're going to utilize options, maybe in a separate account or with a portion of that money, and you can go ahead and take an option strategy and profit from this pullback. Now, as it comes back, maybe you're looking at a support and resistance level right here, and you have a strong feeling, you see MQ momentum turn up. Well, you think, oh, this is a pretty good bottom here. I'm gonna do something so that I'll take advantage, because I have a feeling now we're going to move back up. Okay, and when you do that, you can earn additional income doing that. Now, one opportunity. But okay, let me just go back to that. So basically, you're trading within a channel. Okay, and you can say it can be an upward sloping channel like this. It could be a sideways channel. It just depends. But usually it corresponds to nice levels of support and resistance like we do here. Or we have value levels that we trade at. And usually they're both in the same place. Okay? So what we're going to do, I just wanted to show you this so that when I show you these trading rules, they kind of make sense for what I see is a longer term, either sideways or upward sloping channel. Okay, let's go back. So basically the rules for portfolio protection, and really they're not set in stone, they're more like guidelines. Okay, but we're utilizing range trading techniques. Okay, there's only so far that this can go. It's not going to go ballistic and go parabolic and go straight up. And thankfully so, neither is it going to go parabolically down. Okay, you do have certain distances that it can move and then pull back. You can also utilize MQ momentum here. Okay, we use the plus 25 and the minus 25 levels. If we get too far out of bounds, then it pulls back. Too far out of bounds, it pulls back. Okay, so with that understanding that prices over time trade within certain ranges. Okay, at the high side of the chart, right here on the high side, basically we're bumping up against the resistance level of this ascending trend line. Okay, what we can do there, we can sell a bear call credit spread to earn some income. Okay, we do this in the room all the time. If we feel prices are going to fall or pull back, then we want to go ahead and sell a bear call credit spread. And then what do we do with our long-term equity positions? Nothing. Just hold them. Why? Because this may continue to move up. Okay? Now, why do we sell credit spreads? Well, it has a lot to do with probability. And actually, I'm going to go over this in my workshop on Thursday, that over time, long-term trading techniques that basically involve selling premium tend to be much higher in profitability and a higher rate of successful trades. That's why we do it in our options live trading room on a weekly basis, but also over long periods of time, call credit spreads are profitable. Now, someone asked, do I do it on a weekly or do I do it on a monthly? It depends on how you want to do it. It depends, on the chart that you're using. Right here, this is a weekly chart of the S&P. So you can utilize a monthly structure, okay? Here is the S&P, same time period. This is a daily structure. I tried to make sure it was within the same time frame. That's why we have much smaller bars here. But you see how much more choppier this is, okay? So on a weekly, if you're trading weekly SPY options, then chances are you're going to want to do it daily, okay? But it is a little bit harder to read. You can see on the weekly chart, it's much cleaner looking. You get those significantly overvalued levels. See where we are right now? We're hitting the downside of this ascending trend line, okay? Oh, I'm sorry. We're talking about the upside first, here and here. Okay, so what you can do, again, if you are bearish, remember it's kind of counterintuitive. You're bearish at the high. Why? Because you already feel that, oh, we're bumping up against that resistance level. Okay, the chances are it's going to fall away from that resistance level. So that's where we sell bear call credit spreads. And we can use the same methodology that we use in the room. You don't have to sell it right here at this level. You can go a little higher, and basically what happens is, it's just almost like covered call writing. If the spiders move up towards your short strike here, that's fine. You're still earning money, and you're still below the short strike on the bear call credit spread, so you're not really losing any money. And then this just expires, and you just take the premium. Okay. Well, Brad, you can sell the call. That's another opportunity. Brad's asking, why don't we just sell the call? Well, I'm trying to parallel what we do on a normal, the daily 1 to 3 day swing trades. So technically, you can sell that call. I prefer just to do the spread. It is straightforward. It's something that we can do very consistently. If you are just looking to go ahead and just sell the call, you can do that also. Sometimes we don't necessarily want this to be called away from us. Like if this was, instead of an index, say this was Google or Apple, we don't want our stock called away from us. So that's why we kind of go with the spread there. So, and also it also allows us to sell more spreads if you want to, if you see what I mean. Because if you sell the actual call, then you have more of a buying power hold on your account. I mean, it is secured by the underlying. So, I mean, but in my experience, you can actually sell more spreads because the buying power requirement's much smaller. You're basically utilizing some leverage here also. Okay, but that's a good question. That's a good question. I can see the parallel with covered call writing, but the spreads work out very well, and they both expire, and you keep the premium. Now the question is what happens here if you take the premium? Well, you can do one of two things. You can, because you already feel that it's going to go down, you just hold the premium, maybe use that to purchase more stock as it falls. Or what you can do is take that premium and purchase some out of the money. I'm a little hesitant to say that. I tend to suggest here that you just take the money and look for an opportunity to add more to your positions. Basically, you are basically, I'm sorry, I was just reading a question. I just wanted to make sure I didn't step on the toes of the questioner. But basically, you're protecting yourself by earning additional income. Because you automatically think that this has a tendency to go up. It is going to pull back, but let me move to the next part of this technique, and what happens if we have prices that come back. This is something we can do a little bit more of. Yeah, that's fine, Brad. I use spreads a lot too when I don't own the underlying. You are correct there. It's just the technique that I'm kind of familiar with. I don't want the possibility of my longer term positions being kind of tapped. Another thing too, and this is kind of paralleling your question, if you have the long-term position in your IRA or some other account, but then you have a retail account that you're doing these spreads for protection, well, you don't necessarily have the underlying in the same account to offset that. So you do spreads. In your mind or in your overall portfolio position, you're offsetting one with the other, even though they're not in the exact same account. I've had clients that would do that also. Okay. But again, the other side of this, remember we were bearish at the high side of the channel. Now we're going to be bullish at the low side of the channel. What do we do there? What do we do on this side of it here? Okay. Basically, what we're looking to do here again is to sell more premium. Now, this is with the understanding that we see momentum maybe turning, or we're kind of cementing the fact that we're actually going to be pulling up from this low at like here, here, here. Maybe you're having, you can see it on a shorter term time frame that we have the position actually turning up. Okay, and the reason we do that is because we want to go ahead and sell a bull put credit spread, because we feel that the price of the stock or the index will actually move up from here. Now, you can do that. We take the credit, and then what do we do with it? Well, we can actually maybe buy more stock, because what's happening at this low? Well, the index is cheaper, so we sell the credit, then we take that in money, and then we add more to our long-term position. You can do that. If you're not necessarily certain of that, or don't want to do that, what could you also do? Well, I could actually buy some insurance. I can buy cheaper, further out of the money put debit spreads. And again, why do you do the debit spreads as opposed to just buy the straightforward puts? It's a matter of leverage. Okay, even though the market looks like it could continue to fall, you can buy, like especially if you're using ValueBars, you know that if you kept going down, you'll move beyond this moderately undervalued level and into significantly undervalued levels. If you're buying puts that are in that significantly undervalued levels, they should be much cheaper than, that's a put debit spread, should be much cheaper than what you're selling the bull put credit spread for here. Okay, now that's insurance, because chances are it's going to bounce and move up, and then those just expire worthless. So what you're trying to do in this instance, onto the downside, is not necessarily bring in income. Okay, that's not your primary. these two different things. Bring in some income, but also buy some insurance in case it continues further down. Okay, you're utilizing this kind of credit to buy some more insurance. Okay, chances are it's going to bounce up, and then you'll be fine. These just expire. So it'd be great if when you hit that low for you to go ahead and come out positive, like with a net profit. You sell more credit spreads than what you're buying here. Okay, but if that doesn't work, that's okay. Okay, that if you come out net zero, that's okay. You've protected your downside. Okay, so when we're at the high side, we're taking in income, maybe adding to our long-term equity positions. On the low side, what we're doing is taking in some income to buy insurance. Now, how much of each that you do, it's up to you. Okay, it's just it's a variation of a collar type strategy. But again, at the high side, you're basically bringing in income. On the downside, you're kind of protecting yourself. Okay. Now, if you don't feel, if you feel pretty comfortable in your ability to read momentum and everything like this, and you don't really feel that you need that insurance, that's okay. What do you do with the money? Well, I can add to the long-term equity position again. Why would I do it here? Well, because it's at the low. And the income you earn here, you can hold on to it until you feel this turn comes on. You don't have to take the income you earn here from the bear call spread. You don't have to invest it back into the long-term position until you feel it's at a low price. So you hold on to it and you buy more here. Okay, so a couple of different things you can do. It depends on how aggressive or conservative you are. Okay, now with that understanding and with value bars, usually you're using value bars to signal when help you determine where those turning points are. Yellow bar segments, you use those to enter and exit a position. And you can see on the chart examples, let me erase some of this. Here you get the yellow valuation levels, and that moves in conjunction with the support and resistance levels. We'll use momentum to help you judge that. I know a lot of you are familiar with those kind of ideas because we use them in the options live trading room all the time. Okay, why do we sell here significantly overvalued? First of all, significantly overvalued, and momentum is peaking and it's starting to roll over. Down here, momentum is moderately, the price is moderately undervalued, but why did we buy here as opposed to here? Well, the histogram bar just got shorter and the indicator line turned up. That's a good indication that this could move up the next week. Okay, and vice versa. Just so back and forth and back and forth. Okay, I mean, it's not a very complex strategy. Here's again on the daily chart, it's a lot choppier. But whereas here you might be selling the monthlies, okay, here you can trade the weeklies and you can get 4 times as much, I wouldn't say 4 times as much premium, but 4 times the chances to sell premium, okay, kind of like we do with our weekly trades. So take what we do with our weeklies, apply it to the index, and then, you know, position it for a longer term portfolio. Okay, now just to make it a little easier, see the Dow on weekly, prices are moving, a high here, watch momentum. It's a little cut off, I apologize, just to be able to show you the whole, this whole span. This is probably 9 months. Sell the bear call spreads here, and then buy them when they're down here, sell them again when they're up here, buy them when we're here. You could actually buy protection. Okay, comes back up here. It's a little bit more difficult to go ahead and be bearish here because we really don't have that established uptrend, but you can see what happens here, 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 and then right here we broke through it. So we want to watch momentum and MQ regression. What happens here? Does it peak here and here? I mean, that gives us, if that's a bearish divergence right here, it's an excellent time to sell premium here at the for a bearish call credit spread. and then prices fall back and we take that premium. Okay. Again, this is the long-term view. You know, we're not just sitting trying to trade and make daily profits or even weekly profits. What we're trying to do is build. Think about it. If we buy the index here, like we had $100,000, bought the 500 index right here, okay? Prices move down, prices move up, prices move down, prices move up, okay? Prices move down, prices move up. We're right here, okay, today. You bought the index here, here's today. What happened to your 100,000? It's probably worth about 100,000, okay? So the market's been moving, it's been active, it's been hitting these significantly undervalued and significantly overvalued levels right here, it's bouncing around, okay? But from the time you put the money in to 5 months later and you see the money right here, you check your statement, it's exactly the same. Like, well, why didn't I earn any money? Well, if you had been a little active in your investments, maybe you pull in a little bit here, there, here, there, here, there. Who knows? You might have 100,000. You may have 105,000. Okay, you benefited from the price action. Okay, maybe in these instances here and maybe here, you had some protection that you bought, just in case you just rolled over and the market really cracked and fell through. Just some ideas. Okay, what happens if you put 100,000 here? The markets go up. Not only do you benefit, maybe this is a 10% return, but based on your options trades, instead of just getting 10%, you got 17%. Okay, 17% return year over year versus 10% a year. This is a tremendous difference. Okay. This kind of type of strategy is more for people that want to be a little bit more active in their longer-term portfolio positions. It doesn't have to be something that you look at every day. See, these are weekly charts. Okay, and then the NASDAQ weekly, same thing. And you can see you actually benefit more when, in a way, if you think about it, if the markets are moving in a channel. Okay. I say that, but not really, because we always tend to have a bullish outlook. We're usually long in our portfolio positions. If we have a steady move up within an ascending channel like we had here, I think this is the best. This is the best structure. Okay, just as long as we have some basically pinball action between the high side of the channel and the low side. Okay. Because the longer-term portfolio is growing here. It's just every once in a while you want to be able to pull back so you can invest some more, or sell, or when we stop our pullback, sell some premium down here with a bullish put credit spread. Okay. Really, it's not rocket science. It's just kind of utilizing the tools that you have with options, trying to kind of increase your overall return long term. Again, 10% versus 17%. I'd be happy with 17. That'd be great. Okay, and those are the cues. All right. I'm not really going to go into live examples because it's actually very hard to draw. But I just wanted to see if anybody has any questions. Like I said, I know a lot of you had experience with options, familiar with calls and spreads. Now, let me just say, I don't want to assume, and I apologize if I am. I'd like to quickly show you one thing, because I don't see any questions right now. If you guys, just bear with me 1 second. If you guys haven't yet seen it, if you're not familiar with options, I actually have something for you. I'm actually running a live online trading workshop this Thursday night from 5 o'clock to 7 o'clock Eastern. If you can't make those times, it's okay. The material is still very pertinent to you. Basically, we are going to go ahead and talk about the fundamentals of option trading. Okay, not just say, hey, this is a call and this is a put. This is part of it, but also talking about the primary differences of options versus stock. What dictates what is the value and controls the value of options? It's not just, hey, the stock's going up or the stock's going down, but the volatility, the amount of time until expiration. All those factors come into play with options. That's why in our options live trading, we trade differently depending on what day it is and what kind of strategy we're using, what our outlook is. So we're talking about the fundamentals of options trading. Now, I'm not going into 20 different ways to do various spreads. That's not what I'm talking about. Talking about the fundamentals, the Greeks that matter, that control the vast majority of what is important to us as traders, how to implement the fundamental option positions, how to choose the best one for a particular outlook, and then how to implement them with different time frames. Okay, then we're going to learn how to use and be careful with leverage and control our risk with options. Kind of showed you how to do that a little bit tonight. But then show you how we use them in different time frames daily, like we do in the options live trading room, but also some swing trading ideas. That's how we use that in that particular aspect also. So right there, it is a 2-hour class. Now, that's how much I have scheduled for, but I'll be in there as long as you guys want. And right now, is one, again, it's a fundamental course. It's a lot of material I'll be covering. So really, even at $199, it's a really good deal. But for right now, it's still $99, okay? For a couple of hours, just really get a good foundation. Because if you're looking to trade options, you really need to understand what's controlling their movement. So right now, just go to, if you're interested in it, go to the live online workshops right there, and then click more. Right there, you can sign up right there. Here's the specifics again, benefits and objectives. Another thing too, if you're not currently in the options live trading room, the included with this workshop is free access to the trading room all next week. Okay, so you'll not only get to learn this stuff, but you'll see it implemented the entire next week. Okay, so right now it's still on sale, $99. Encourage you guys to go ahead and sign up if you can. Okay, so right now, let me see, I don't see any additional questions. Let me double check here. How do you determine what strikes you buy and sell? It depends, Brad. Like I said earlier, with the different options, let me just see here. Like when it's very similar to how we do our swing trading spreads intraday. I'm sorry, on a weekly basis. What we do is if we feel that the turn is occurring, we'll say right here on a daily basis, or we see on a shorter term time frame like a daily, that the momentum is actually turning and from negative to positive, then we will go ahead and write, in this case, a bullish put credit spread, okay, to take it to the upside. Now your question is, how do we determine which strike? Well, our strike is determined more so based on how far, for our spread, how far down do we think prices are not likely to go. It's kind of a convoluted way to say it, but what we want to do is position our short strike far enough away from the current price so that it's not likely that prices will come down there and bounce up. Okay, very similar. We don't write it for right here because we think it's going to bounce. We actually leave a cushion. Now, in this particular case, if we write it for down here, how do we benefit from this particular spread? And it's something, again, I'm going to cover in the options trading room and in the training class. But we take in premium. So we have money that comes into our account based on the spread, and over time it degrades. It becomes cheaper. But what happens is if the prices move away and go in the direction we expect them to go, we earn money because of delta. if prices that's the way we think prices are going to go up. Okay, what happens if prices don't go up? The way they go sideways. Do we earn money? Yes, because we get to keep the premium. What happens if it starts to drift down? Oh no, it's going opposite. It's going towards our short strike. That's not necessarily bad, because what happens is, as long as it's not a steep fall, or prices, and more importantly, prices stay above our short strike, then we get to keep that premium because the options we just sold expired. Okay? We don't necessarily use standard deviations like most people do, Brad, because some people say, well, we're right here and standard deviation's down. Why? Because if we just utilize just standard deviations, we are utilizing a mathematical equation, and we're kind of negating some of the advantages we have, like right here. This is significantly undervalued. I'm not selling a short strike way down here. If I feel that this has a good chance to bounce, I'll be a little closer. Okay, right here you have the low here. That gives us a support and resistance level, and here in this case it's a support. I could write the spread for down here if I want to be conservative. Why? Because we have a previous low here. Chances are it could hit that support level and bounce up. That's another thing. If momentum is starting to turn and move up, and that's kind of why we'd be getting into this trade, that's another opportunity that allows us to say, okay, I don't think it's going to come down. Why? Well, because it's significantly undervalued. There's a trend line here for support, and momentum is actually turning. Okay, I have 3 factors that is telling me prices are going to move up. But not only that, I have a buffer here. I get to keep this premium. It's great. When I go to play football, I want the biggest guys on my team to give me the best chance to win. Same thing here. I want momentum on my side. I want support and resistance levels on my side. I want value levels on my side, and I want a cushion. Plus, I want it to expire in 3 days. Okay? You're like, Dave, that's really hard to find. Yeah, it's really hard to find, but you can find it. And on a weekly, on a weekly, that we do that every week in the Options Live Trading Room. So take the class, learn the Greeks, come into the Options Live Trading Room next week. It's $99. It's really, you're not gonna, I could charge $995. Okay, how do I scan for these, Brad? Well, I know I'm kind of talking about stocks now because that's what we mainly deal with, but when we're managing a long-term position, we're always watching the spiders or the Dow, something like that. But how do I scan for these? Well, in the Options Live Trading Room, let me just show you. We get to this. We keep a list of stocks that we trade options with all the time. Apple, Google, Amazon, Goldman Sachs, MasterCard, LinkedIn, Netflix, Priceline, MasterCard, Visa, a lot of them, and we watch them. We watch them on a daily basis. We get to know them, mainly because these have the most actively traded options out there. You don't want to be trading positions that trade 10 contracts in a day. You want to trade something like Apple that trades 4,000, 5,000 options in a day. Okay, it narrows the spread. It gives you a lot of liquidity, stuff like that. Yeah, I agree. Thanks, Ron. I agree. There, Ron was basically commenting on the value of that workshop, and there are companies out there that charge $995. And I'll tell you, when they're, and I've seen those classes, I've taken some, and because I'm always trying to learn. And the thing about it is, it's great when it works out. If it doesn't work out, you got to be really careful, all right? Because if you don't do credit spreads the right way, you can get a little beaten up, okay? You guys still be careful. There's no free lunch in trading, okay? So, and I share all that with you in the Options Live Trading Room and then also in my workshop, okay? So again, back to the Options Live Trading Room. We trade intraday usually at the open in the first hour, hour and a half. Then we start looking for swing trades. We did that a great amount this afternoon. Got some good positions. They went against us, and then they worked back out towards the end of the day. And this is where we do primarily buying and selling put credit spreads and call credit spreads based on which way we think the stock's going to go. And we try to earn a consistent income, consistent return every week from our spreads. Excellent, excellent program. I mean, even though, you know, performance is not necessarily indicative of future results, I shared with the room today, over the last 9 weeks, we've averaged 5.5% every week with the money committed to the credit spread writing program that we do. Okay, not bad, not bad, very consistent. All right, directional, and then another things that we do, again, directional puts and calls, that's our intraday trades, and here are the spreads. The trading room hours are 9 in the morning to 1 p.m. in the afternoon, and then it's $149 a month. Might seem expensive, but we're in there 4 hours a day, 20 hours a week, and that's 80 hours a month. So that works out to about $1.50 an hour. So $1.50 an hour. A lot of opportunities to earn money. Great trading, a lot of fun. So I just wanted to take a second to show you the options live trading room. I'd love to have you in there. The thing is, what we can do, give me an email. Send me an email if you're interested in trying it out. Actually, we do have the ability to try it out now. Let me just see here. If you want to go to the trading room, your live trading room options, here's all the description of it, and if you click right here and add your information, we'll get you in there for a free week trial. Okay? It's a great opportunity, and again, whereas in the summer things were, honestly, towards the last part of last month, it was fairly dead. We still made a good amount of money, but it was still fairly flat. Now we're getting into some opportunities, some increased volatility, more price action. So it's more active, and I think there's going to be more opportunities for more trading as we go. But right there, live trading room, can get right in and give it a shot. Okay. But again, if you have any questions, feel free to send me an email at dave@microquant.com. Happy to answer any questions, and you know, start a discussion with me if you have questions. Brad's asking, okay, first of all, let me just see here. Ooh, some couple of questions. Does signal feed help you to scan? Again, Brad, I don't have, say, 100 stocks that I scan. Just because I like to know really well what I'm trading. You don't need a lot of trades every month. I mean, every week. We probably do anywhere from 5 to 6 spreads a week. You know, sometimes 4. Last month it was 4. So with 20, 25 stocks that we follow, we'll get an opportunity there. Yeah. Now, like I said, that is just a historical number that when I did the calculation, was about 5.5% per week. That's what we averaged. Okay. Now, with that said, I can't tell you that that's what we're going to do this week. So, but again, it's our methodology that I'm proud of. That, I think, lends to the consistency of the trading that we do. It's not that, like, oh, okay, this week we knocked it out of the park, made 25%, and then for the next 3 weeks we were -10, and then he nets out for 5%. That's not what it is. We like to be consistent. I think there was 1 week that we came close to, you know, just being up like 1%, but that's fine. I have no problem with having a break-even week. Let me put it that way. Put it in a positive way. It's a break-even week. Didn't lose any money, didn't earn any money. I can take break-even trades, no problem. So just, like I said, try out the room, okay? Do I trade a lot of straight puts and calls, Brad? Yes, we do, and we do them primarily intraday. Primarily intraday. In Apple, Google, Amazon, and we have traded Tesla before. Tesla is like a freight train going straight up, though, so you got to be careful with that. But primarily intraday, we do it at the open. We do it maybe a divergence or two after the open. It just depends. Sometimes we try to catch a breakout. 5.5% of what? That's a good question. 5.5% of the money committed. A good example, and if you know spreads, we trade 10 contract spread. It's a $5 wide spread, so it's a total of $5,000 of buying power that is held up because of the spread position that we have. Again, 10 contracts, $5 wide spread, and then so 5.5% of 5,000, and that is roughly 250, maybe a little bit more, 250, 300. Okay. If you come to the room, you can see it. We have positions on right now. Okay. Let me see if I can show you an example. So this is what you see with the Options Live Trading Room. Let me see if I still have that. Sorry, I know I'm kind of jumping around here. And my people in my room know that I'm very interested in making sure everybody sees what we're doing. Right here. These are the positions we have right now. Apple, we have a bull put credit spread. Google, put credit spread. These are done, I believe each of these have 12 contracts. Okay, so if I sum it up, all of this, 1,200. So this is 6,000 plus 6,000 plus 6,000 plus 6,000. So roughly 12 on $24,000 of buying power. Okay, I think that's a little bit low. 12. And everybody's got their calculator going. That's about 5.05%. Okay? Trying to be a little bit careful. You can see a lot of this is bullish right now. It's just the way the market opened up today. It's quite strong. Carried a lot of stuff up. A lot of stuff looks to be bouncing this week. And the week after a holiday tends to be a little bit stronger. But again, we did this conservatively. This is not a taking here. Since you guys can see it already, Apple. See the purple line at 4.75. As long as the price of Apple stays above $475, can you all see that? As long as it stays above $475, you get to keep this $276 by close of business on Friday. Okay. Next is Google. Prices stay above $840. We get to keep this $300. Okay. Next is Amazon. If the price of Amazon stays above $280 right there by Friday, we get to keep this $368. And then last but not least, Goldman Sachs. This is probably our most difficult one. Okay. As long as the prices stay above 150, we get to keep the $268. Now, we monitor it, we manage the position. Some companies out there say, here's the trade, put it on, and let's just keep our fingers crossed because it's 2 standard deviations away. I don't go for that. I got to have some more. I have this support, I say I have this support level here below these lows. I have momentum turning up. I have this other indicator. It's called a squeeze indicator. So you may be familiar with it. You see how the histogram bar is actually getting shorter. So it's actually carrying things up. The indicator line's coming up. Okay, so I'm watching it. And again, we were actually very strong today. So that's Goldman Sachs. I mean, Apple, same sort of thing. Watch MQ regression. Watch momentum. Okay. Google and Amazon are probably our strongest. See, this is a bullish divergence here. Okay, bullish divergence. Histogram's going up. green on the histogram bar. Amazon. See, I'm giving you guys extra information. Here, we hit this support level multiple times last week. Then we jumped up above this support, this previous resistance level. Okay, now we're way up here. Histogram bar is green. Squeeze histogram bar has been shortening here, so we're becoming more positive or less negative. Okay, a lot of different factors. Plus, we put this thing far away as we can. Okay, but Google probably is our best example of that. See how far down we are? So there's a lot of opportunities here. How much capital is required for those 4 trades? Again, 24,000. Okay, that's how much this is committed. But again, like I told you, I put 12 contracts here, 12 here, 12 here, 12 here. If you have $4,000, you could do 1 contract, and that would hold up 500. 1 contract here, 1 contract here, 1 contract here, and that would be a total of $2,000. You would get, you know, a couple of $100 right there. It's all scalable. If you had a couple of $100,000, well, instead of doing 12, you could do 25, 25, 25, 25, and this number would be twice as much. Okay, it's all up to you. The numbers don't change. The rationale behind the trades don't change. Okay, it's just the amount you commit. Okay, and it's no harder to trade 1, 2 contracts than it is to trade 12, than it is to trade 20, because these are not intraday trades. You can ease into this. And again, we're not talking about stocks that trade 10, 11, 12 contracts in a day. I'm talking about Apple that trades 4,000 contracts in a day. Amazon, 2,500 contracts in a day. Google, you know, $4,000 or $5,000 also, $4,000 or $5,000 contracts also. So that's how we do the spreads. Okay, but again, the question is okay, that's great, Dave. Well, I don't understand exactly how that works. That's what the extra workshops are for. Okay, take the fundamentals class, enrich yourself by understanding really well how options work, and then come to the trading room for a week. See how we do this. Okay, you guys can ask people in the room. I always try to make sure everybody's on board. If you're a little bit new to the room, I could always work one-on-one with you a little bit. I take the time to explain the trades. Okay, and also we manage these trades throughout the week. I put all these on today. I won't just turn it off and go trade something else. I watch these. Actually, you could around 11:30 today. We started seeing these. We put them on probably around 10, around 11:30. You can see here at Google. We started falling back. Here, we started falling back. Kind of watched and managed trade. Really didn't do anything other than maybe added a couple of more positions. Okay. Does that answer everybody's question? Hey Jim, yeah, I didn't look at LinkedIn yet. Let me just see here, LinkedIn. Yeah, very good, cool. So anybody have any questions, feel free to shoot me an email. I'd really like to see you guys attend the options, the fundamentals of options class. I think you'll get a tremendous amount out of it, and if anything, if it can help you avoid one bad trade, maybe buying the wrong option, you know, learn the rationale of how options are priced and how to take advantage of them. There's right ways and wrong ways to use options. To be honest, there are in whatever particular situations. Okay. All right. Anybody have any last minute questions? I know I keep you guys 12 minutes late. I just wanted to make sure you guys were aware of some of the stuff we do in the room. But again, just to summarize, you know, utilize options. Yeah, I'll leave this up here so you guys can see it. I won't close the room down completely. Set those rules back up. Okay. Oops. Oh, goodness. There we go. PowerPoint doesn't like me sometimes. All right, so those are just general techniques, some ideas as to how you can utilize different types of spreads and you know, what to do for longer term portfolio protection. Okay? Anybody have any last minute questions? All right, well, thank you again very much for your time this evening. I know we're a little bit over, so again, I appreciate your attention and effort, and I look forward to seeing you guys in the Fundamentals of Options workshop. If you have any questions or would like to try out the room, shoot me an email at dave@microquant.com. I'm happy to work with you and get you guys exposed to the opportunities we have in the room. Okay? All right. Thanks, everybody. Have a great evening. All right. Good night.